Today we will look at financial statements. There are four main financial statements used by business managers to make decisions. They are the balance sheet, statement of comprehensive income, statement of changes in equity, and the cash flow statement. All four provide managers with understandable and accessible information that allow them to track business success and take corrective action to improve business performance. The first statement we will look at is the classified statement of financial position, or the balance sheet, which uses the fundamental accounting equation assets equals liabilities plus equity. Assets include current ones like cash and non-current assets like business equipment, which are the resources of business that are able to provide economic benefits in the future. Liabilities are the future obligation of the business and are divided into current liabilities, which are less than 1 year, and non-current liabilities, which are more than 1 year. Finally, equity is the difference between assets and liabilities and represents the share of the business by its owners. The balance sheet can be used to persuade potential shareholders to invest, as it shows the past performance of a business, indicating the direction the business is going. The next statement we will look at is the statement of comprehensive income. The income statement reports a company's revenues and expenses over a specific time period and shows how successful the business has been. Revenues are the resources generated from business activity and are the critical element of business success, as higher revenues lead to greater profits. However, expenses are high, the revenue will be useless. Thus, this statement is able to pinpoint specific areas where the business can improve, including lowering wage expenses by laying off staff. The income statement is used with the balance sheet when calculating retained earnings in our next statement, the statement of changes in equity. This statement shows how the contributed equity has performed in a period. The net income from the income statement, together with dividends from the balance sheet, show the retained earnings of a business. This is a critical source of information for potential shareholders, as high equity means lower risk and sustainable growth of the business. The final statement we will look at is the cash flow statement, which shows how changes on the balance sheet affect cash inflows and outflows. It is broken down into three parts: operating, investing, and financing. Operating is the cash generated from the core activity of the business after purchasing assets, which is the investment part of cash flow. Investing is a cash outflow with the aim of eventually generating a higher cash inflow from operating activities. Finally, financing is the funds used from either debt or equity sources that show the direction the business is taking. In conclusion, financial statements are a key source of information used by external and internal users to make decisions that impact on the success of a business. By providing understandable and accessible information, users are able to make informed decisions. The four financial statements all link together in providing reliable information in regards to past performance, while also providing answers to the future success of a business.